With the Labor Department's big, bad, non-farm payroll report coming up on Friday, it's worth trying to get a read on the employment situation in this country. Few businesses have a better understanding of the job market than Paychex, P-A-Y-X for you home gamers. Here's a company that's the #2 payroll processor in the nation, specializing in small, medium-sized businesses where most of the hiring happens. They also have a robust human resources and benefits outsourcing division. So with that labor report looming, we're lucky that Paychex just reported this morning, with the company delivering in-line earnings on top of slightly better than expected revenues, up 7% year over year, though the stock did close down more than $1 or 2.2%. Paychex is very much hostage to the Federal Reserve because they collect interest on what's known as the float, the money that's sitting there in the time between when the company's clients fork over their payroll budget and when you then actually cash your paycheck. So when the Fed raises interest rates, Paychex instantly becomes more profitable. In short, this is one of the few companies aside from the banks that directly benefits from a rate hike. And even though it seems like Janet Yellen's unlikely to tighten too aggressively, as we know from yesterday, Paychex is paying it away, 3.15% yield. Let's take a closer look with Marty Musi, the president and CEO of Paychex. Learn more about the quarter where his company's headed. Mr. Musi, welcome back to Mad Money.
Thanks, Jim. Good to be here.
Marty, let's start with some great stuff here. On the positive side, you noted that the net payroll client growth year to date, strongest since the Great Recession.
That's right. We're feeling pretty good. It was a solid quarter, good selling season. And we're seeing a lot of growth, particularly in our mid-market, those 50-plus employee clients. So we had a good selling season, and like you said, year-to-date net client gain is the highest since pre-recession.
But it does seem like it's weird geographically. I mean, some areas just aren't doing that well, and some areas are doing great. Any insight in the ones that are doing great and the ones that aren't doing that well?
Well, yeah, based on our small business index that came out yesterday, it's very much on the coast. The coasts are the strongest. Right from the southeast, the Florida, Georgia region, right over to the west coast and right up to, to the Washington state. Those are the strongest, whether it's high-tech jobs or construction, I think, on the south. In the middle central part of the region, not quite as strong because they're impacted by energy, lower oil prices, and decrease in fracking work.
So when you listen to Fed Chief Yellen, who I think is actually speaking for the common person who's not making that much more, I mean, you look at the other side of things and see, as you did in your conference call, that checks per client in the quarter, they moderated. So, I mean, she's not off base with what she wants to do.
No, they did moderate. And so, but we do look like, we introduced the small business index yesterday. It's the highest increase in the first quarter. So for the last 3 months, that's the highest 3-month increase we've had in 2 years in small business job growth. So on the other hand, small business job growth looks like it's coming pretty well. We did moderate a little bit in checks, but overall, I think, things are going pretty good right now.
How much of that small business growth would be service, say restaurant, retail, and how much small-scale construction, where I see some real pickup?
Well, it definitely is leisure and hospitality and other services. We've seen this before, and they've been the strongest. They're having the best growth. So these are discretionary services, and some of those jobs, Jim, are part-time. So we are seeing that. Construction picking up in the southeast and the west coast, and we do see that in the housing industry. Although new housing starts are flattening out a little bit, but we have seen that construction up as well.
Yeah, it's not booming, but not bad. Now, the human resources business has been so great for you. I mean, 39% now versus 61 payroll. If the Fed doesn't raise, will there become a time when you come on the show, and I'm always grateful when you come on the show, where human resources is 50-50 with payroll?
Oh, I think it's going to. It's growing. It's been growing double digits for years, and we see no end in sight on double-digit growth in those sales and in the revenue side of that. It's growing very well. We're adding more product, and we're selling more full bundled product right up front. So not just payroll and then sell an ancillary, an HR product, but now we're selling it right up front. Clients need it at a much lower level because of the complexities that are out there.
Now, I know that a lot of the analysts are saying, listen, Affordable Care Act, it'll be, we're going to cycle through it. And I felt that some of them were kind of saying, is it one and done? To me, it seems like that's not the way to look at it. It's that there's more regulation every single year. And it doesn't seem to matter even what party. It just seems like there's more regulation. And therefore, there's more ways to get in trouble. If there's more ways to get in trouble, the way to stay out of trouble is to hire Paychecks.
Well, you're absolutely right. Whether it's the Affordable Care Act, which I think we said we still see at least one more wave of that increasing the sales, I think, but also like overtime regulations, we've talked about them. They're going to be coming out in the next few months. Big increase in the need for time and attendance solutions, mobile punch. They're going to need a lot more time and attendance information for overtime. and there's going to be all kinds of needs for wage information and HR outsourcing because it's just more complex at all levels of business today.
And when you go in for the bundle, there was a great moment in the conference call where you kind of describe what your business was like 10 years ago versus now. I just want our viewers to know, because 10 years ago, I think people would have said, hey, no Fed rate hike, sell. But the business just doesn't look like that now because of what you've done.
Right. It's very much, first of all, it's a lot more technology. So the last 5 years, we've made a very significant investment in technology. And that's what the clients want on top of the service options that we've given, whether you're served by multi-product centers now to handle all your products in one place or 7x24 service. But the other big change is that clients need more at a smaller size in their business, and they'll take it right up front. So they don't just buy payroll and then we come back and sell everything else. We now sell you the full bundle of services many times right up front. That's what you need. You don't look for payroll, you look for HR support, including payroll, and that's the way we're selling to you now.
Well, you had a great quarter. I know that the stock tends to be emotional right around the earnings, and then a few weeks later, it's up nicely. That's Marty Mucci, President and CEO of Paychex. Good to see you, sir. Thank you.
Thanks, Jim. Good to be here.
Good yield, good growth, my kind of stock. Stay with Paychex. Stay with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.